Good morning, traders. So here we are on November 29th. We're a few minutes before the open. This earnings trade that hopefully no one made, okay, is we're going to be opening here shortly, and we're going to see how this double diagonal is going to react. Now, again, the premise behind this trade, why no one should make this trade, is as you can see, this trade looks like it is a no-lose trade. In theory, it looks like no matter what happens to the underlying CrowdStrike, this trade models as though it's going to make money. I want to point out that the modeling, the fact that it's modeling incorrectly is nothing to do at all with OptionStrat. No matter what modeling software you look at, if it's using some of the standard modeling methods out there for options like Black-Scholes or any of the others, there's about 3 of them, it's going to model for all practical purposes the same way here. And why that is that modeling software does not, in most cases, have a mechanism built in that can deal with options that are at 2 different points in time. Our short strikes here are December 1, expiring this Friday. Our long strikes are out on December 8th, expiring next Friday. So that creates this, essentially, this double diagonal sort of situation here. You could do double diagonals 2 different ways. You can do them the way I've done it here, or you can do them the opposite, where this long strike is going to be below the short strike, which in this case, that would have possibly worked out as a decent trade. That's a more likely trade to make than this one, but I'm showing you this one again because this one models as though it looks like, oh my gosh, I can't lose on this trade. And I know many, many years ago when I started options trading, I felt like I found the holy grail here, and I went into a couple of these trades with larger size than I should have because I thought I found something. And as you'll see very, very soon, I did not find something other than a big losing hole. So you'll notice here, CrowdStrike shares are trading higher after the company reported better than expected earnings. Okay, if we look at a chart of CrowdStrike, we can see that last night it closed here at around the 212. At the start of the conference call, it dropped 12 points down to 200. This morning, it's rallied up to 224. So this thing has had a pretty wide range on it. It's been down as much as 10%. Now it's up as much as 10%. So that's a 20% range on this stock in a pretty short time. I said 10%. Actually, I guess that would be 5%. We went from 212 down to 200. So, anyhow, very wide range overnight on this stock. But let's look at where 220 would put us. So 220 would put us right around in here to where it looks like we should have a fairly decent profit. Now, one of the things that we can do with OptionStrat that we can't do with any other program that I'm aware of is the ability to come in and look at how these 2 different expiring strikes work differently. So I can come in and take a look at how both the front and the back change, okay? And I can see how those change. If they change about the same, if the front changes the same as the back, I can see how that might react here in this trade. Okay, but another thing that's really, really cool, let me reset this, is I can come in and say, well, what if my back strikes, my long strikes, what if the money drops out of those more than it drops out of the front? So what if my back, the volatility in the backs was, let's see, about 58. So what if that drops down to, 25 or so? And then the front maybe drops a different amount. Maybe the front doesn't drop as much. Okay, maybe the front only drops 30%. something like that. That's unlikely. Usually it's going to be the reverse, but even if it were the reverse, we're going to see in this case, that wouldn't necessarily be a good thing. But the key that I want to point out here is that with OptionStrat, I can at least model how these, how this might look if the front and back strikes were to change at different rates, and they will change at different rates. After the opening and after we see how this plays out, I'm going to pull up the actual prices on each of these options, and we're going to compare them to the price of the options at our entry, and we're going to see how much they the individual options changed in price as we go through this. So again, I just wanted to point out right now this really cool feature. This is not available in the base level, by the way. You have to have a more advanced level of OptionStrat, and it is on sale right now, by the way. So take advantage of that Black Friday or Black Week sale to upgrade your OptionStrat now to where you have this feature as well as a number of other really cool features that aren't in the base model. But again, this is a key one if you're going to trade any sort of time spread. So with that, I'm going to center this back up. We're averaging these back out. We're going to come in here and basically just go with the volatility that it has in this trade right now. And again, we're a few minutes before the open. I'll be back in just a few minutes. We'll see how this changes at the open. Okay, everybody, so we're about 15-20 seconds before the open here. Now, it's going to take a minute or two for the prices to start flowing in on this. So you're going to hear the ding, ding, ding of my Thinkorswim platform, and it's going, there we go, and it's opening, and now it will take a minute to roll in. I'm going to refresh my screen here because I had done some other stuff on here which shows a different kind of a different look there. Oh, there, the drop happened while I was refreshing my screen. That's too bad. But regardless, you can see here that all of a sudden this no-lose trade that existed a minute or two ago now does have a fairly sizable valley of death as part of this trade, something that did not exist a minute ago. Now, in a short bit, I'm going to get into the numbers. I'll end up pausing this video and coming back, and I'll end up taking each one of these prices individually and comparing it to the prices when I open. So look for that coming up later on in this video, and I'm not going to try to do that live because I'll pause each one of these separately, capture them, and then kind of pull them all up at the same time to do a little comparison. But that said, right now, the important takeaway is that people can see that this particular trade does, in fact, have a significant valley of death, where when it modeled, it did not look like it did. The underlying at this point is trading up here at around 223. And again, it had shown that at 223, it should have had a very, very nice profit to it, but it simply does not. So again, that's one of the times, about the only time I can really think of, that modeling software and the different modeling methods that are out there, Black-Scholes, etc., don't model a trade that has a time spread involved in it properly. And again, what I mean by that is there just simply isn't a way to take into account how the difference in these options, how the volatility is going to change differently in the front month to the back month. I mean, it's hard enough to anticipate how the price of the options might change from the 195 to the 200 if they're in the same expiration, but at least they're kind of linear. You're comparing things on the same plane, if you will, and that's a single plane, the single plane being the price plane. The date plane is all the same. So you know, if these were the exact same date, then we're just dealing with the difference of the 5 points, and there are ways that you can mathematically model that pretty well. But when you're dealing on what I'll call two planes, or I kind of refer to this as four-dimensional chess here, because we're not only dealing with different strikes, but we're also dealing with different expirations, the 2-8 versus the 12.8 versus 12.1. So that also then comes into play. So these two that we're looking at aren't even on the same expiration date, which much further complicates the whole issue. So again, I'll be back a little bit later where I'm going to be actually looking at the numbers as it relates to each one of these options, but I want them to decay a little more during the day here so that it gives a little more realistic picture of how that outcome looks like. So I'll be back to you on that. Okay, so let's pick this up and take a look at exactly what's happening here. Now, one thing I do want you to note is that this trade is actually up fairly nicely right now. However, that wasn't really the lesson here because, CrowdStrike is all the way up here, which is all fine and dandy. The issue that I wanted to show was, of course, early on, this showed no possibility of loss. And that's the piece that I want to make sure that people understand, that while the modeling shows no possibility of loss, there is, in fact, significant possibility of loss. So why or how is it that happens? So I think the best way to maybe explain this is if I take those exact same strikes, where the 200, the 195 put, and again, this is essentially a reverse iron condor. Rather than being short here, let's see, we are short the 195. So we're short this, we're long this. We're short this, we're long this. So that creates a reverse iron condor, which again, there's nothing really wrong with that reverse iron condor trade, other than you have to know that if you do land between here, you're going to be hurting. And that's essentially what had happened with that double diagonal, is that we had done a double diagonal, but it was done in the case of a reverse, essentially a reverse condor. And so that does then create this massive valley of death that you would not have if it were a more traditional iron condor. Of course, we all know the more traditional iron condor, you're going to have loss on the outside, you're going to have gain on the inside. So this is going to be your winning area here, and your losing areas are going to be out here. So that's what would happen with a traditional condor or a traditional double diagonal. Now, that traditional double diagonal, if we had done it the opposite in this case, where we had switched these, that one might actually be losing a little bit right now. But it would also show you on the P&L diagram, it would show you that there was potential loss on the outside edges of this trade. The reason this one did not show that, if we look at our cost basis on these, we bought the one for 373, we sold one for 183, we bought one for 513, we sold one for 298. So by the time that we get all of that factored in, you end up with essentially the diagram that we had here, which again, at the start of this, did not show any potential chance of loss. So we have to take into account essentially that this trade, while we have added a time component to it, this trade unto itself is a reverse iron condor with time spread here as well. And again, that's what creates that anomaly of it looking like it holds up in the center when it actually does not. So it's a difficult concept to try to explain because we are dealing in essentially 4 dimensions. We're not just dealing in, down and up. We're also dealing in dates. We're dealing in the time spread as well. So what I urge people to do is, particularly in OptionStrat, because we can't easily do this, is go and do exactly what I did here. Enter a trade, mark out all your entry prices, and then look at the trade after the open and see where the pricing in this case has gone to. Where did the bid and ask on these go after the open? and basically just do a little spreadsheet on them. Look at what did you pay for each leg, or what did you take in for each leg, and then look at the values of those afterwards and study how they changed, how they varied during the course of the trade before and after earnings. And I would also point out, again, with OptionStrat, particularly the elevated versions of OptionStrat, you also, of course, have the ability, let me turn off my drawing tool here, to model these separately, the December 1st separate from the December 8th, which again, you won't find in most platforms. So anyhow, that's all I really wanted to point out here, and what I wanted the big takeaway to be was that you are essentially, when you do a trade like what we had done here that looked to have no loss, we're essentially doing a reverse condor with a little bit of time element in it, and when you add in that time element, it looked like there was no loss in this thing. Again, prior to the earnings being announced, it was looking kind of like this, to where there was none of this potential loss, but that loss is actually there in this particular trade. And I don't want people to get fooled like I did many, many years ago, thinking, oh, I've got a guaranteed winner here, when in fact you don't. So with that, I will wrap up this trade. Again, I know it went a little deep, and hopefully it made sense. Go back, watch it again if you're not sure. Always, too, in OptionStrat, kind of nice, you can come in here and look at all the different trade types. So you can come in here and you can do calendars. Calendars are going to be a little more complicated trades, so I'm trying to look here exactly. So you can put on a call calendar, a put calendar, kind of see how those two things play out against each other. Now, these are going to be a regular calendar. If you want to reverse them, of course, you're going to have to switch which one is your short strike, which one is your long strike. But play with those. Again, look at them, track those values before or when you open the trade, and then take a look at the values after that binary event, in this case an earnings announcement, happens, and see where they end up then. So hopefully you find this useful. Take care.